I'm Doug Goldstein. Thanks so much for joining me. Today, the question I want to bring up is one that I hear quite often. In one way or the other, people ask me, Doug, how can I invest, get maximum growth, lots of liquidity, but no risk? So I have to tell you that, frankly, the question is a reasonable question. You should ask an investment advisor about such investments. What I always like to answer people is that there are two worlds in the world of investing. There's the real world, and there is the fantasy world. And unfortunately, in the fantasy world is where you can get super high returns with lots of safety and lots of liquidity. But in the real world, it's just not that way. But let me give you an example of some of the things that people sometimes hear, and they think that they are high-yield, low-risk investments. Well, let's start with the simplest one. One of them you might even consider would be simply putting your money in the bank. Let's say you took $100 that you could have used to buy a new jacket, and instead you put it in the bank. And then next year when you went to take that money out and buy a jacket, you would take out $100, but instead of that jacket costing $100, now it might cost $105. And that's the effect of inflation. It means that the cost of goods and services goes up, so your money in the bank, in fact, wasn't that safe. You also find, by the way, because our original question was what are high-yielding investments with low risk? It's true, the risk of the bank is probably relatively low because it's insured by the FDIC, but the yields really are low. Relative to most other investments today, bank deposits pay very, very little. Sometimes people buy CDs, certificates of deposit, either at their bank or through their brokerage firm. And although those investments are FDIC insured, if you hold them to maturity, if for some reason you need the money and you sell it or you have to cash out early for some reason, you could either lose the interest or you might actually lose money by selling it on the open market. So it's not obvious to me that banks fit the two criteria we were looking for, which is high returns and low risk. So what else do people look at? Have you ever heard of annuities? Annuities are a common investment that people will use. They're issued by insurance companies, and basically you give your money to the insurance company, and they promise to make certain returns for you along the way. There are many, many different types of annuities. Frankly, one of the complaints that people have is that there are so many different types that it's really hard to understand what the differences are. Simply put, there's fixed annuities and there are variable annuities. There are more, but let me just talk about these for a minute. A fixed annuity, as the name suggests, pays a fixed income rate to you. In a low interest rate environment, however, the rates on fixed annuities can be very, very low. On a variable annuity, the value will go up and down depending on the stock market. Now, often they'll tell you, yes, but your principal is guaranteed. And the thing you have to ask is, well, when does that guarantee come into play? And in most cases, a guarantee on an annuity means you have to die. Why do you have to die? Because an annuity is an insurance product. There is a life insurance component associated with the investment. And frankly, I don't know a lot of people who are looking to die in order to make sure that they break even on their investment. So although, just like the bank deposits, there is a place for annuities in some portfolios, I think you really have to understand the pros and the cons because it's a pretty serious thing. So what else do people look at? Probably one of the most common investments in the world are buying bonds. A bond is just a loan that you make to a country or to a company. You lend them the money, they promise to pay you back plus interest. And that promise is the guarantee. But don't forget, the guarantee is only as good as the guarantor. So a bond, in fact, could default. And interest rates, if interest rates are low, the interest rate the bond pays you will be low. And if you look for a bond that pays a very high yield, simply called high yield bonds, they're also known as junk bonds. And again, I'm not saying it's a good or a bad investment. It really depends who you are. But by virtue of the name, I hope you can tell that a junk bond is a lower quality bond. It means it's got more risk, and that's why they're paying you a higher interest rate. So what do you do? Well, the first thing, and I always talk about this, is you have to figure out what are your goals with the investment. Start by figuring out your goals, then determine what your tolerance for risk is. And I hope you see that from bank deposits to annuities to bonds and every investment out there, real estate, stocks, mutual funds, exchange-traded funds, everything has got some kind of risk. The trick is understanding what's your tolerance for risk and using the financial plan to figure out what's appropriate for you. So the answer to the question, is there an investment that has high yields and low risk? I'm sorry to tell you, but the answer is no. Doesn't mean you shouldn't invest. It just means you can't hope that you're going to find some magical investment when it really doesn't exist. And my last point on this is if someone tries to sell you such a thing, just walk away.